Hello and welcome to today's webcast, Navigating Dodd-Frank Trading Mandates in 2014 and Beyond. We'll give everyone 2 more minutes to dial in. We've had over 500 folks signed up, so welcome to those who signed in already, and we'll kick this off shortly. Okay, so we'll kick it off. Hi, my name is Chris Rodriguez. I head up sales and marketing for Eris Exchange. I'd like to welcome all of you to the co-sponsored State Street Global Exchange and Eris Exchange presentation today. I'll turn this over to Scott Parsons of Delta Strategy, our moderator, to drive the panel discussion in a moment. Before I do, please note we will provide ample time for audience questions and answers towards the end of the presentation. You can use the question submission feature in the webinar software to enter questions anytime, or you can utilize the email address webcast@erisfutures.com, which will appear at the bottom of all the slides during the presentation. Plan to record the presentation and send the playback to all registrants as well, and we'll post this on our respective websites. So without further delay, I'll turn it over to Scott.
Thank you, Chris, and welcome to everybody today. I want to say thank you first to State Street Global Exchange and Eris for sponsoring this very timely and important webinar, which has obviously generated a lot of interest and for our panelists. We have a good group today. We have in State Street itself, Eris, a designated contract market, and then John Griffin from Hartford Investment Management Company, HIMCO, and Mike O'Brien from Eaton Vance, so good buy-side participation as well. We're going to try to cover a good bit in this hour, and we're going to go through a lot of different topics regarding SEFs, SEF membership and access, swaps. We're going to talk about swap futures. We're going to talk about order books, evolution of SEFs, post-trade workflows, blocks, and anything else that the rest of you want to talk about. So I think rather than delaying this, we'll get right into it. And Neil Brady, I'll turn it over to you to talk about Eris.
Great, thanks, Scott, and thanks to our partners at State Street for co-hosting this webinar along with us. We're very excited. Scott mentioned to talk about this, given the timing, and that we're right here on the heels of the, right before the trading mandate kicks in mid-February. So just a couple of minutes of just introduction about, what is Eris Exchange. I'm the, by way of introduction, I'm the CEO of Eris Exchange, and Eris is a full-blown futures exchange, a designated contract market, or DCM. As Scott mentioned, we're not a SEF. However, as the Dodd-Frank legislation discusses, the trade execution can be fulfilled by either trading on a SEF or a DCM. We offer today a futures contract based on, for U.S. dollar-denominated interest rate swap futures. We trade in 2 varieties. We trade standardized contracts, which we refer to as our standards, which are quarterly, IMM-dated, fixed coupon contracts that are fully nettable. And we also offer flex contracts with yield curve granularity, out to 40 years to specific dates and specific coupon levels. As you see in the graph in front of you, not surprisingly, we're gaining a lot of traction here as we head into the trading mandate into February. Our open interest just ticked over 92,000 contracts. That's up, 350% year on year. That's due to a whole host of new users coming to the market, a diverse group of asset managers, hedge funds, proprietary traders, bank dealer desks, and we'll talk more about that later. And the final bit of introduction before I hand it over to Tom is that to trade on Eris, we offer two modes of execution. First we have a full central limit order book, which is anonymous, with streaming prices, shows bid-ask depth. We have streaming prices for our benchmark standard contracts at the quarterly dates. We also have streaming prices throughout the trading day for our benchmark flex contracts, which are basically swaps in the benchmark tenors. We also offer execution off exchange through our block trade facility and our EFP facility, which we'll talk about in more detail later. But essentially we offer best of both worlds, either that full electronic access that people come to utilize in futures, or off exchange access for more customized trades or larger size trades. So with that, I'll hand it over to our partners at State Street and Tom Zickas.
Thanks, Neil. So, hello everyone. My name is Tom Zickas, and I'm representing State Street Global Exchange. We're really excited to be in a position to continue to offer State Street's customer base and everyone else involved in the market with some forums for thought leadership and innovation. In terms of State Street Global Exchange, we represent the sales and trading businesses, so that incorporates SwapX, which is a fully registered SEF. We also support through State Street's FCM futures and OTC clearing, as well as futures execution. And we also have technology synergies with Eris Exchange. From State Street's perspective, we've really, I think, benefited from our interaction with the customer community because we have unique access based on our custody relationships with the customer community. On one hand, we have the asset managers that we are very heavily involved in, and also on the hedge fund servicing side, we've had that access. Through the balance of the hour, I think we're going to end up touching on several, if not all, of kind of what I consider open issues in the market. So I think the market generally has reconciled itself with the baseline trading activity that the MAT mandate brings about. However, there are still very hot topics being debated, and I'm sure we'll get into them. I've listed some on the graphic that you have in front of you, but just to kind of rattle off, there's still questions about recording obligations for CFTC Regulation 1.35, and in particular, how does that impact the macro hedge fund community? There's also questions about how do you really have electronic access to unwind transactions, basket unwind transactions, and there's a lot of confusion or misinformation around portfolio compression and how that can actually be affected. The prime brokerage community, particularly in areas where you have permitted transactions, is a hotly debated issue, and there's still some questions about the reporting impact of the confirms. Package transactions, an area where I think we'll spend a fair amount of time on in this hour, is a hot topic, as well as kind of how do dealers, or how may dealers facilitate agency access to liquidity and perhaps immunize customers from needing to take the entire force of the bullet of MAT and Dodd-Frank. And then obviously complexities around trade voiding and how that impacts allocations. We see opportunity in both the OTC and the future side of the business, and we're very supportive of both from a technology perspective. Now turning over to Mike O'Brien.
Hi, my name is Mike O'Brien. I run global trading at Eaton Vance, and we've been heavily involved in the derivatives market for a long time, trading derivatives in currencies, rates, credit, and commodities for many years. So Dodd-Frank has had an impact on our business. And when we think about what our trading business looks like moving forward, we're looking at both CEFs and swap futures. And the way we've been thinking about it is in terms of what the most appropriate trades are for things that can be standardized, which I view as more appropriate for futures, and things where we're tailoring specific risk or hedging a specific risk, which would remain in the OTC space. And so we've been engaged both with swap futures. We started trading swap futures a year ago. We've been involved in the Eris futures as well as the CDX futures that existed for a short period of time. On the OTC side, we're engaged with all the CEFs. We plan on being ready to trade on the CEFs when the February dates hit. That is certainly more complicated given all the new regulations. Whereas we're more familiar with the futures regulations. The new regulations are taking a bit of time to come up to speed, but we do plan on being ready for that at the February dates and plan to execute some of our non-standardized or all of our non-standardized trades on CEF. Now I'll turn over to John Griffin to discuss how they're preparing.
Hello, this is John Griffin. Good morning to all. I work for the Hartford Financial Services Group's Asset Management Division, the Hartford Investment Management Company, where we oversee both the general account of our insurance legal entities as well as institutional third-party accounts. Similar to Michael, we are knee-deep in getting prepared to transact on CEFs. We are not yet using swap futures, but we're following the product to see how the market evolves and if it may fit our portfolio managers and traders' needs. Really, right now, as I'm sure most of the participants on the conference call are busy getting up to speed on the various rule books for the CEFs they've chosen to partner with and onboarded with their CCPs, FCMs, CEFs, middleware providers, etc. It's going to be an interesting month as the clock is now ticking. Sorry, now Scott Parsons from Delta Strategies. Scott, please.
Thank you, John, for that. Thanks for everybody participating in those introductions. What's on your screen now is a visual that will set up some of the topics that our panelists are going to be talking about today. This is something that our firm put together for our clients who were saying, I'm reading about this in the newspaper, I'm getting bombarded with calls, tell me when things are going to happen and what they're likely to look like. And so we started this with the clearing mandate, which preceded the trading mandate, obviously. And it would have been too messy to put everything up there, so we just simplified it and put the trading stuff that will be discussed today. So the first box to the bottom left there is the first MAT determinations, and we'll talk about the MAT process here in a moment. But you see the CEFs that are provisionally registered that triggered the MAT determinations by filing a list of contracts that they would like to be subject to the mandate with the CFTC. And you see the dates of when those will be effective. Next, another issue, if you move to the right, is the block calculations, which some have said, gosh, I didn't realize it was moving that quickly. The calculations are based on a notional value. A distribution test is the way they do it, which is fairly complicated. Most of you probably understand it better than I. But it's at 50% now. It'll move to 67% in April, which is right around the corner. The top box is a Bloomberg determination. It's insignificant in the sense that the contracts that were filed by Bloomberg are nothing's new in that filing. They're all captured by the ones that were filed earlier. But we put that up there just to show it. And then on modes of execution, SEFs have to offer a central limit order book, but they can also have RFQ functionality. And a hotly debated topic here, but the commission, CFTC, ended up saying initially it's RFQ to a minimum of 2, and that phases, or it changes to 3 later on this year in September. Outstanding issues are issues that we hear about from our client base, and we'll talk about that today. Are you know, the biggest one is package trades, which Tom mentioned earlier. So I think with that, this is just kind of a setup to what we're talking about. Tom, we'll go straight to you, and we'll kick off the panel discussion. Do you want to talk about, or will you talk about, what made available to trade swaps are, and what does it mean at a practical level?
Sure. So I think for most folks, you'll be familiar with what the MET set of instruments is, but if you don't have that and you want to know the specific details, the best place to go is to the CFTC's website at www.cftc.gov, and if you go to the Dodd-Frank section and just look at press releases, you'll see a very clear summary of the MAT. At a high level, you're talking interest rate swaps, which are covering the tenors of 2-year, 3-year, 5-year, 7-year, 10-year, 12-year, 15, 20, and 30. As Graham pointed out, the effective dates are February 15th for those, and that includes dollar-denominated, the next 2 IMM start-dated U.S. dollar swaps, and euro-denominated swaps. And that's in line with Javelin's submission. The second date, which is February 21st, the additional instrument of market-accepted coupon swaps, or MAC swaps, have been added. And then you also have on February 26th, based on TradeWeb's MAT filing, the addition of pound sterling, LIBOR, T+0 starting swaps, as well as credit default swaps, specifically the indices of investment grade and high yield 5-year, as well as the iTrax Euro and Euro crossover 5-year instruments. So that's it in a nutshell. Scott?
Oh, I'm sorry. I had you on mute. Tom, before we get away from you, I think we ought to talk about package trades. And since that's such a hot topic, you want to take that one as well. And maybe Neil, you have some comments on that as well.
Yeah, absolutely. So in the MAT filings, most of the MAT filings had some commentary about package transactions, and there was some discussion as to their exclusion from MAT. I think in the press release dated January 16th, the CFTC Commission stated something along the lines of that the CFTC would not per se relieve market participants of the obligation to trade such swaps on a DCM or a SEF if one of the legs of a package transaction happened to fall under the criteria of MAT. And I know that there is a roundtable scheduled in mid-February. I think it's February 15th, to discuss that specifically. And my opinion is that the CFTC is in a tricky spot because they can't open up an infinite loophole for allowing package transactions to be a means by which you can avoid regulation. However, there is also an interest from the market, that the market's concerned that having a kind of a universal blanket requirement of package transactions having to go on SEF is perhaps, without any phasing, is maybe a little fast. From SwapX's perspective, when we just look at a very popular and narrow package transaction like a swap spreads, I think we have a very interesting, viable, and workable solution. But obviously, when you get off of maybe curve trades and maybe the swap spreads, and you get into more specific constructs of butterflies and the like, it gets complicated in terms of accessing liquidity. So there's more discussion to follow here. I believe that, in my opinion, the Commission will not give a broad exemption for package transactions, but may offer the market some time to catch up to this requirement and offer a little bit of time relief.
And this is Neil from Eris Exchange. I'd jump in here to say that while we're not directly affected by the package trade issue, we do watch it with great interest and hear about quite a bit from end user clients. I think there's a pretty broad consensus that from both buy and sell side that a little more time is needed to handle some of these package transactions. And as Tom mentioned, the CFTC clearly looks like they will include these in the math determinations, and then give some sort of phased-in timeline anywhere from 30, 60, 90, 180 days to support all these trades via CEFs or DCM. From our perspective, and I think the industry's perspective, for us, certainty around the timeline is really the key, rather than maybe the specific dates, whether it's 30, 60, 90. That's less important than we think. Galvanizing the industry around specific dates, similar to the way that the clearing mandate worked, and we believe that's what sort of we're going to see over the next couple weeks. Just specifically as it relates to Eris, just to clarify, I mean, all of the MAT equivalent trades, all the benchmark tenors, we support all those in futures alternatives today on Eris, and the package trades as they get mandated, we offer guaranteed package spreads on our platform for calendar spreads, yield curve spreads, and you can also handle other spreads against cash, against other instruments via block trades, EFDs. So we support all of them. We stand ready to support that when the industry is required to trade those on an exchange, and look forward to this rolling out over the next 60 to 180 days.
Thanks, Neil. And I would just add to that. I think the roundtable, the CFTC roundtable that Tom mentioned, is going to be on the 12th. And if you think about the comments that they'll get there, the determination needs to be made before the 15th. So not a lot of time remaining for that discussion, but I think it is expected that there'll be some additional time put in, and the real question is how broad will it apply, and how long will it be? So we'll turn to sub-membership and access. And John, this is probably a good question for you from a buy-side perspective. Do the buy-side participants have to join CEFs to be compliant with the new trading mandates? And what does it mean to join a CEF? What's involved? And then maybe Tom, being a CEF yourself, you'll have some additional comments.
Yeah, so I guess I can't answer on behalf of the buy side whether they have to or not, but if they would like to continue trading swaps that have been made available to trade, then yes, either directly joining CEFs or through one of the aggregation platforms people may be speaking with. Hopefully, as we close out January and enter into February, which should be a fun month for all of us, people are well along the route of doing their due diligence with the various CEFs that are coming to market and have chosen who they want to partner with. The process is relatively straightforward. There's usually a fairly simple participation agreement and a fairly complex rule book involved. I'm sure legal and compliance officers are knee-deep in rule books at this point, and traders are busy reading those on nights and weekends. But it's going to be an exciting month for all of us. The made available to trade, obviously being the mandated on, I think it's Tuesday the 18th is the first business day for rates, and then the 26th for the CDX indices that Tom mentioned. We are hearing that a lot of the CEFs are seeing slower than one might have expected ramping up in terms of, I would guess that people are either already trading electronically or firms like mine, which are trying to do a lot of trades for test purposes just to make sure we've properly onboarded ourselves with the CEFs that we're partnering with. and that everything from the SEF to the FCM to the CCP is working properly in anticipation of the mandatory dates. I'm going to be very curious, what we're all most interested in is the liquidity on the SEFs and where the buy side is attracted to. Frequently, SEFs are asking the buy side where they want to join, and realistically, it's kind of a joint discussion among SEFs from a technology perspective, dealers from who they're partnering with and where they're going to provide the liquidity, and then the primary buy-side firms of where they choose to ask their dealers to join. So it's not a one-sided conversation at all. It's very much a, this is how the market is evolving, and we all need to get there together.
And I think, sorry about that. So I think, if you're going to trade interest rate swaps, you have fundamentally two paths that you can choose. You can either become a direct participant of the SEFs, and as John mentioned, you're going to have to go through the rule book and sign the agreements and get comfortable with the liabilities and obligations associated with that. Or alternatively, you could either because maybe you're behind the curve and you need some more time to catch up, or you are really seeking to immunize yourself from that process. There are several kind of thought-leading dealer entities that are facilitating on behalf of access into a SEF. So basically, the customer can communicate an order to their dealer, who will then be the legal participant on the SEF to convey that order. And those are essentially the two options. On SwapX, we deem that a Rule 406 customer on the latter side. And whether or not a SEF is prepared to support that kind of on-behalf trading really comes down to a question that is less structural in nature, but more looking at the technology capabilities as well as kind of the fundamental economic model of the SEF. So in order to facilitate on behalf of trading, you need to have a robust API or a robust kind of way in which the dealer can connect to you such that they can convey orders in the legal entity identifier and in the clearing account with the clearing account information of the underlying customer. And kind of the fundamental economic model of the SEF also needs to be open to receiving access. So some SEFs, they're looking at subscription-based models, or the kind of screen-based proliferation of revenues. They're probably embracing this, but their model is more to be the distributor themselves as opposed to funneling that through a single counterparty. So we see kind of both paths being embraced right now, and I think the dealer option, for those entities, buy-side entities that have maybe found themselves a little short on time, are really looking at that as a viable option to get them into the market and maybe avoid the full brunt of the legal exercise of rule books and participant agreements.
Thanks, Tom. Let's talk about the rule books for a minute. And John touched on this a little bit, but may want to add some more color. I mean, there are 22 SEFs that are provisionally registered, which is a strange situation, because what that means is the CFTC has not reviewed and approved the rule books, so which may make it even more challenging. They're all a little bit different, and so John and Mike, I guess from your perspective, other than hiring an army of lawyers to look at all the rule books, how are you handling this? And then both of you guys, after commenting on that, let's talk about accessing the SEF liquidity.
Well, fortunately, personally, we're not asking our traders to read all 4,000 pages of the 22 SEFs rule books. But there's a lot to absorb there. As one would expect, there's a lot of legal language and disclaimers, but there are key points within there that we're working closely with our colleagues in legal and compliance to make sure the traders are aware of. Fundamentally, to some extent, it all boils down to what Tom hit on, which is, there's a liability there, but most of us have done electronic trading on platforms before, so we're kind of used to those rules of the game. And then really the rule book stress, you can't manipulate markets, which is kind of a duh thing to have to stress in a rule book. So assuming that all of our traders are going to use them for the risk management purposes that we all use swaps for, we can make them available. Traders will review them. We, through our training, over the next month, we'll make sure that they're aware of how the new landscape works. But I don't think, and my compliance officers would kill me for saying this, people should be that worried about the rule books. Just get through them, familiarize yourselves with them, and get ready.
Yeah. On top of that, from a buy-side perspective, this is something new for the buy side. We're used to, in the OTC market, where the old bilateral market, where everything was negotiable, including the ISDAs that govern most of our contracts. The rule books are more or less take it or leave it. I mean, there can't be a rule book for every fund in the industry the way that there is on the ISDA side. The question of the rule books and whether you want to be subjected to the rule books, I think also impacts how you want to access CEF liquidity. If the rule books are something that the buy side is not comfortable with, that can determine how you access. I mean, how can you access CEF liquidity without being subject to the rule books? Now, you always have to, you can't manipulate markets, as John mentioned. So in that sense, you are responsible for the rule books. But there are certain aspects that some buy-side firms may not be comfortable with, which they may be able to get around by how they access the market. And for that reason, the rule books, I think, are important to know and understand because they're going to impact how you trade.
Thanks.
And Mike, this may be sorry, Scott, Mike, this may be naive of me to say, but one would expect for any rule book that was an outlier in terms of egregious expectations of users to quickly verge towards the market norm.
Yeah, I would agree. I don't know how long that will take. Whether that will be done and everyone will be comfortable by February 15th or 18th, I guess, for a business day, or whether that takes longer. That's something to be considered. These rule books are changing, and they can change, hopefully for the better. So that's something to be watching, I think, over the next 6 months.
Those are good points. Neil, let's talk about swap futures. What are these things? Talk the folks through the evolution of swap futures.
Sure. If I might, just one quick comment on the last question, just to clarify. With respect to futures in our rule book, I mean, one of the things we hear a lot about the hours people are spending with the CEF rule books, and one of the value propositions we're offering in the market is actually just that certainty, because our rule book has been fully vetted by the CFTC and the DCM process. Unlike, as Scott mentioned, the sort of provisional process that's going underway for the CEFs, where in some sense the sand is shifting underneath as people are going to market, which is one of the difficulties that the industry is facing right now, because it's not exactly clear whether certain rules will stand or whether the CFTC will question them or modify them. And our rule book is based on decades of sort of futures industry experience and sort of fits in line with that. So that certainty, we think, is what the market is looking for. We think the CEF world will get there. We have it today, and it's based on, in terms of access, the agency model where you can execute directly, you can get sponsored access, you can execute through a broker who can execute on behalf of, where you can execute block trade off exchange. So just to sort of tie out in the last question. As to the swap futures question, as many as there have been a number of attempts to launch swap futures, interest rate swap futures in the past. None of them have met with much success. So the question would be, why is it going to work at this time? What's different? Really, we believe there are two fundamental things that are different. One is product design, and second is the timing and everything we're talking about today with the regulatory, external regulatory drivers. In product design, we think swap futures in the past have had a structural basis from actual OTC swaps. We won't go into all the details here, but we believe with the Eris contract design that settles, cash settles to the CME Clearing's OTC swap curve and clears of the CME. We believe we've addressed that issue, that we no longer have that structural basis to an OTC swap. So that's huge, and nothing will work without the correct product. And then secondly, as we're talking about here today, there never before in the history of the market has there been a requirement to trade exchange-traded, swaps on an exchange, which then creates an opening for an alternative product like a future that rides off of all the infrastructure, which we'll talk about a little later in the webinar, but the pre-trade credit controls and the automated allocations and give-ups and all of the sort of margining and portfolio margining of futures. So we think those two factors, the product design plus the external drivers and where we are with the market today, are leading to some very encouraging results, and we're seeing expanding volume. And anybody's guess how this plays out, but we're quite excited about what's to come.
Thanks, Neil. Mike, it's probably the next question is for you. What do you think about swap futures, and do you think that there is some chance in the future that this product or these slate of products would replace swaps? And John, you may have something to add as well.
I don't think, although I'm a strong supporter of swap futures and futurized swaps in general, I don't believe that it'll ever replace OTC swaps. I think that swap futures, as a standardized product, if the economic exposure you're trying to get can be done in a standardized product, it should be a swap future. If what you're trying to do is not standardized, it's appropriate for the OTC and the CEF market. So those two markets will always exist side by side. Given that swap futures started, as was just mentioned, there's been a lot of failed attempts in the past. They basically started at zero. They're going to take market share from the OTC swaps, but I don't believe they're ever going to replace them. But I think swap futures have significant advantages over a standardized swap. There's a known regulatory framework, and a lot of the issues we're dealing with in Dodd-Frank, like record keeping, reporting, middleware, bunched orders, RFQ rules, all that stuff, is not something you have to worry about in swap futures. At least for the moment, there's more attractive margin. So I think that it makes sense if you're going to trade something standardized to do it in the future. The reality for a lot of the buy side, however, is not every risk you want to hedge or position you want to put on can be done in a standardized format. That's why the OTC swaps exist. And so I don't believe that swap futures will ever completely replace the OTC world, but there's going to be a significant market shift towards swap futures.
Yeah, and I think our counterparts at Eris are hoping that open interest on swap futures rises to $650 trillion, but I don't think we're going to see that.
Thanks, guys. Tom, let's talk about the order books and execution. Can you talk a little bit about the trading protocols on CEFs?
Sure, absolutely. So, it's no secret that from a CEF's perspective, for any instrument that the CEF wants to offer, there must be an underlying order book. So that's kind of regulatory requirement number one. So all the CEFs that are out there, you should expect that for whatever they offer, there would be an underlying order book. Now, whether or not that order book is actually utilized, in certain cases is completely irrelevant. It just has to exist. And the other protocol that everyone's familiar with that is permitted is also the request for a quote. And I think when you look at request for a quote and order book in combination, you've just defined that MAT phase one baseline trade. However, when you look past that initial day one trading activity and the CEF has to kind of justify the value that it's adding to the user community, there's a lot of other innovative protocols in the market that are being looked at and embraced. So some examples of those would include like what we offer on SwapX, which is indication of interest. You can think about it as a kind of a request for order book. So it's a request that generates a spontaneous order book such that for whatever construct of swap you want, you can actually create a flow of liquidity. There's also popular formats called matching sessions where a curve of pricing is presented to the market, and people can come in and deal at that rate in a kind of scheduled session environment. You also have the requirement for unwinds is driving innovation around basket unwinds. So being able to create a basket and seek a single net present value in a request for quote format is another protocol that's being introduced. And then, around package transactions. How do I get a package transaction done on a fully automated, streamlined electronic basis? So, on a swap spread, if you trade it, you should be expecting to receive in that transaction, a treasury as well as the cleared swap, and have those cleared through the relevant clearing houses. So that's just a glimpse into some of the trading protocols that are being presented by CEFs.
Thanks, Tom. Now, Mike and John, probably a good question for you. Based on that description and your knowledge of these trading protocols, obviously buy-side participants have fiduciary requirements to their investors to execute at the best price. Do you feel comfortable that these protocols meet that requirement?
Well, they effectively become it, because if you're dealing with matted products, you have to transact on a CEF. The question being, of course, whether it's through an RFQ or a central limit order book. Traders need to have access to both. We all need to be partnering with the CEFs that we think are going to have the dealer liquidity to ensure that we're achieving best X on behalf of our clients. I think there's a very interesting opportunity here. It's unfortunate the regulators had to force the fixed income industry to move electronically, but maybe its time has finally come to open up to a broader than a phone relationship with the dealer community and possibly achieve a better than was previously achieved best X through greater liquidity and transparency.
I would agree, and I think the what's interesting about sort of at least the central limit order book requirement is it enhances how the buy side can execute and achieve best execution. The interesting part is I think the central limit order books will only exist, and I think most people probably agree, at the most liquid points in the curve. But the ability for the buy side to be both a price taker, which we've historically been, as well as a price maker, is a very interesting concept, and one I hope the buy side picks up on, which could increase liquidity as well as increase the ability for buy side trading desks to achieve best execution.
Yeah, and that's a great point. Even if you're at an off-the-run point on the curve, being able to look at a club and see where the 1s, 2s, 3s, 5s, 7s are trading is helpful transparency if I'm a buy-side trader.
Yeah, and just one quick comment here, Scott, before I hand it back to you. I mean, from just clarification on Eris and futures, I mean, it almost by definition, best X is embedded into the model with a real central limit order book, where you only can execute at the best price. I mean, there's a really unprecedented level of transparency in transacting a swap. We think the swap market will get there with central limit order books, but the futures model offers that today up and running.
Yeah, thanks for that, Neil. Let's and Tom, maybe you could take this one. The rest of the curve, the contracts that hadn't been submitted, particularly in interest rates. What's your opinion on when those will be captured, including age swaps forward starting, and then Tom, after you weigh in, John and Mike, maybe you could weigh in on what you want the answer to be.
So. People will remember the initial MAT filing made by Javelin was, what people jokingly called the nuclear option, right? And it created a very visceral reaction from the market. But, so the whole notion that I think the industry is embracing, which is a phased, sensible approach to incorporating this new electronic regulatory workflow, is a sensible way, and I think the market is kind of self-regulating itself to time that. That being said, what does the roadmap look like? I think it's true, and anybody that is in the routine of pricing the swap that will tell you it's not like they wake up in the morning and stretch their arms and say, oh, I think the rate for this swap is X. There is a robust modeling capability that exists behind the entire curve of the swap. So really the fundamental question comes down to how can you connect that pricing model? How can you react to an electronic inquiry as quickly as possible so you have the best chance of putting your best price in front of the customer in order to make that transaction happen? I think that happens relatively quickly. This baseline trade, day one, mat date type of activity, let's say February, March, April, is really going to move pretty rapidly, probably on a voluntary basis as opposed to a mat required basis to embrace a broader instrument set electronically.
Given that we're going through the biggest regulatory change since the deregulation of commissions in the 70s, it's wise, as it was with clearing, to ease into it, let the most plain vanilla things, kind of the dust settle over the electronic trading of them, and I think we should all be focused on getting ready to trade those products in February as opposed to speculating as to when we think more points on the curve or other CVX indices or single names are going to be mandatory.
Yeah, I would agree. I want a phase-in approach and probably a longer phase-in, than some are anticipating. This, unlike clearing, clearing went off, those mandates pretty much without a hitch. But we had been able to clear for a long time ahead of that. I mean, we started voluntarily clearing 9 months ahead of clearing, so we had a long time to be able to work out, any kinks in the system before the mandate hit. At this point, I don't think I'm alone on the buy side where, a lot of, on the swap side, the OTC swaps that I was doing, close to 100%, as of September that I was doing were electronic. Once the rule books hit, that went back to zero. So I have not been trading on CEFs. Now I have this mandate in a month. I don't know if the technology works. I don't know, what type of problems to anticipate. There hasn't been as robust a period leading up to the mandate as it was with clearing. So I don't think we should rush into adding things until the technology is proven and the market proves that it can handle it.
Thanks. And we've got a couple more issues to cover, and we'll try to do so quickly where we can get into the questions from the listeners. John, Tom mentioned new workflows a moment ago. One thing that's discussed is credit hubs. There's been a lot of discussion around that. What do you think about the readiness of that? And then, John, after you answer, Neil, if you could talk a little bit about how these tools compare in swap futures.
Yeah, credit hubs and pre-trade credit checks are going to be an important piece of the CEF puzzle. Many people were probably already using credit hubs just as a mechanism for monitoring their credit limit capacity utilization. To touch on so they're going to be required, so I would recommend people meet with them and pick one and get onboarded. From a workflow perspective, as we saw with clearing, whether you were a category 1, 2, or 3 user for clearing, the workflow changed then. It's going to change again now, from round tripping it from your order management system to a CEF to your FCM CCP credit limit hub, back to your back office processing books and records. We have been working closely with our colleagues in operations to make sure that the new workflow works as well as possible from their perspective, because this is not just about trading and liquidity and best X. It's also about operational and technological efficiencies. So I would, from a partnership perspective, highly encourage everyone on the phone and their colleagues to make sure they're doing whatever they can to make their colleagues and operations lives ideally more efficient.
Yeah, Scott, so I'll jump in here. This is Neil from Eris. I think in the futures space, we obviously have a core suite of the mature post-trade tools that the industry has been relying on for many decades, and I think this is something we've always had built into the value proposition at Eris. But now as we race towards the trading mandate, this is becoming more and more talked about, more attractive to the end user community and even people making prices as well, the sell side. We have, for example, average pricing, which is well known in future. You can trade our standardized contracts at various MPV levels throughout the day, the fixed coupon contracts, and then aggregate that into a single trade price at average price at the end of the day. We have seamless electronic give-ups. You can trade through one clearing member or executing broker and seamlessly, in an automated fashion, give out to numerous other clearing parties at the end of the day. We have automatic, sub-account allocations. We write off of all the CME's post-trade processing tools, which are well known to the industry. So in many ways, we are where we know the swap market will get to at some point, and sort of thankfully from our perspective, we're not spending the thousands of hours in the working groups and designing this and going through all that. We watch that process, with great interest, but again, we have a lot of that. We have all those tools built in today.
Thanks, Neil. I think we had another section on block trading, but I think maybe, Chris, what we should do is go straight into Q&A, and if somebody has a question about blocks, just submit it. Chris?
Sure. Thanks, Scott. We've got a number of questions. We'll try to keep it to an hour here. So this first question, what is screen liquidity like on Eris central limit order book? This one will go over to Neil.
Okay, sure. So first up, the prices, the stream prices are available, on Bloomberg and Eris one go. So I'll give a little description, but they're available for anyone to see. There's nothing like looking at the prices to see for yourself what's there. I mean, these days we're seeing increasing liquidity, increasingly tight bid ask. We've got about 1.5 million of DVL1 on average, up on the platform. Anywhere between 3 to 4/10 of a basis point wide. Very attractive liquidity is how we phrase it. We're getting increasingly good feedback about that. It's only getting better as other bank dealing desks and alternative liquidity providers are connecting to stream to the platform, and we think it'll show especially well versus the liquidity on the SAP platforms come mid-February, which will improve over time. We think we're out to a good start here.
Great, thanks. This is for Tom. What are the key areas of concern for State Street's clients? Is there a difference between asset managers and hedge fund community concerns?
Sure. So I think from State Street's custody customer perspective, the universal concern is the issue of books and records and the proliferation of line items on books and records. Both the hedge fund community and the asset managers need to find the elegant way to affirmatively tear up and extinguish their line items by SF, and that day is coming. On SwapX, I know that that can happen on a single line item basis via request for quote or indication of interest, or as an RFQ as a kind of a basket transaction. So that's one. A second area of concern, really more focused on the asset management community, is allocations. And most SEFs, that's a complex problem for order book handling of allocations and doing the credit check on an allocated level. I would say most SEFs are not technologically equipped to handle that yet. And that gets even more complicated when you think about void ab initio issues at an allocation level and how that interacts with the order book. And I know State Street and myself specifically representing SwapX, we're active with the FIA to kind of staff questions about that. I think the relative value trading is really the focus of the alpha-seeking hedge fund community. They want to know that the relative value trade, curve trading, and swap spreads, for example, that they can continue to find liquidity for that, albeit it's not on the MAT, but because of the package transaction scenario, people are very actively working with us to find a solution for that.
And Tom hit on another great point, which was one of the things everyone needs to be working through as part of their project team is are you a pre-allocator or a bunched order allocator? That's key to the SEFs you're working with, your FCM's onboarding of you, CCP actual clearing, and operational and accounting workflows downstream. So please take that into consideration as part of your conversations.
Thanks, John. Next question. This one will go to Mike. How many SEFs do you think you'll join in 2014, and what are the factors in choosing those SEFs?
Just due to technology and cost concerns, I can't possibly connect to every SEF, and so I will connect to probably, I would imagine, somewhere in the range of 3 to 5. And in addition to that, I will make use of the aggregation services as a hedge to make sure that I don't make the selection wrong. Anytime you're picking a SEF, you're making a bet that's where the liquidity will be. I'm not in the business of predicting where the liquidity will be, and so I will have say 3 to 5 SEFs as well as an aggregation platform and probably an agency desk to call so that I can access liquidity no matter where it is.
Yeah, similarly, we're, because of just, project team bandwidth and capacity, we've got our day one partners that we're in the process of getting onboarded with, and we then day two, and by day two I don't mean a year after, but very soon thereafter, want to expand to beyond our day 1-3, probably within 2014. I would hope to have my traders and portfolio managers live on 5 to 6, representing multiple venues, be it credit or rates. Also speaking with the aggregators, because those are a very interesting possibility of reaching out to more than one would normally connect to.
Thanks, guys. On a previous slide, there was talk about post-trade tools. Does Eris, this is for Neil, does Eris offer a compression tool or an optimization service?
Yes, we do. And as Tom mentioned earlier in the webinar, this is an increasingly important area that people are focusing on. We do have a tool. We're getting more and more requests for demos of that. We have conducted several basket trades in recent weeks as this issue sort of hits the forefront. And effectively what our tool allows you to do is to trade in a very OTC-style workflow, take a basket of our standardized contracts or flexible contracts, several line items all at once, and then get them quoted to you in an aggregate NPV and report them into the exchange in aggregate NPV with an aggregate credit check. So a very topical question, very important issue for both SEFs and for Eris and futures.
Thanks, Neil. This one, we've got a number of questions about NDF, so I'm going to roll them all together for all the folks who submitted them. This one's for Tom. Do NDFs have to be traded over a SEF? Are you seeing a shift from NDFs?
So NDFs, they don't have a clearing mandate, so therefore they're outside of even being eligible to be MAT. They are viewed as permitted transactions. If an entity wants to trade electronically, they have to do that through a registered SEF. So the SEF that is offering NDFs has to be registered. So from State Street's perspective, the dealer-to-customer workflow of FX Connect has led to a migration to SwapX for the purpose of transacting NDFs as well as CurrentX. However, the truth be told is a lot of entities are, because they have the ability to opt to do voice trading, have opted to do that in order to allow the regulatory dust to settle before they perhaps get themselves in a bind with regulators in terms of how that's progressing. So I think that was the early sentiment, from October to today. We're definitely seeing an acceleration in the adoption, the customer community adopting NDFs electronically via venues like SwapX.
Great, thanks, Tom. We'll take one more. We're right on time here. This one's for Scott. Can you touch on how the new commissioners will impact trading in 2014?
Yes, Chris, I thought I was the moderator. I didn't know I was going to get questions. I'm kidding. Yeah, I mean, it's an interesting time because historically, we have an acting chairman at the CFTC right now. Historically, when you have acting chairman, they don't do anything, and because they're waiting for the confirmed chairman to be put in place to make the bigger decisions. And we're going to be in a period here where that's not going to be possible because some obvious decisions have to be made. I mean, we've talked about a lot of them today. So we're in an interim period. Mark Weegan is the acting chair, and you've got Bart Chilton, who's 1 foot out the door, and then Scott O'Malia. So we could be at 2 very quickly on a 5-person commission, and at a critical time in the development of these regulations. Our expectation is that the bin nominees are made by the White House for all of the open spots, so 3 open spots, and we expect that those individuals will not be confirmed by the Senate until at least April, and it could be longer. So we're going to be in a period where we're going to be, working with some interim chair and commissioners, and without a full commission. So that's a long way of saying when we get to the point where we have a full commission, they're going to need some time to ramp up their expertise and get caught up on where things stand. So I think there's going to be as many delays as possible in terms of big decisions. But again, some of them are going to have to be made in the interim with an acting chairman. So, and we don't know what the views of the new people coming in, and if we have three new people, I mean that's 3 out of 5. So I would expect that there's going to be a big learning curve, and there's going to be a lot of interest in the views that these new people take.
Thanks, Scott. So we're going to cut it off here. This concludes our question and answer session. We'd like to thank our co-sponsors, State Street Global Exchange and Eris Exchange, as well as you, Scott, Delta Strategy, for moderating, and our buy-side panelists, Mike and John from Eaton Vance and HIMCO, respectively. We'll send a playback to all participants and post this on our respective websites. We encourage you to contact us with any follow-on questions and hope you found this useful. Thanks again on behalf of our sponsors, and this concludes our program.